If you want to invest like the top 1%, well, today I'm going to share with you guys a 54, 27, 14, 5 portfolio allocation that will allow you to massively grow your wealth over time. It's a portfolio allocation that ultra high net worth individuals use that have allowed them to acquire net worths in the region of £4.4 million. Now, to be clear, that's the exact figure that you need to acquire in order to be in the top percentile here in the UK. Now, that's a long way away from where I'm personally at right now with my own investment portfolio, but it doesn't mean that we can't follow the same portfolio allocation. We can just do so, but in smaller amounts of money. So let me share with you guys exactly what that portfolio allocation is from the High Net Worth Asset Allocation Report. Let's start off with the biggest slice, which is 54%. Just over half of a high net worth individual's net worth is actually stored in equities. For you investing beginners, equities is just another word for shares, which is just a portion of ownership in a company. Now, of that 54%, it's actually split into two types of equity ownership. First up, we have 37% in public equities. These are companies that are listed on a stock exchange like Apple, Microsoft, and Tesla. Warren Buffett is one of the most famous investors out there, and he's got about $280 billion worth in about 41 different equities. Now, it's kind of easy to understand why the likes of Warren Buffett and you watching this video potentially might want to invest into the equity markets, and that's because he's got a proven long-term track record of providing really strong returns to investors. In actual fact, here are the annualized returns of a bunch of the major world indexes over the past 20 years. Now, to put some numbers on this, assuming similar rates of returns in the future, and obviously a caveat here, past performance isn't always indicative of future results, and using the example of my own investment portfolio, which is valued roughly of about £67,000 right now, if I continue to invest in something like the S&P 500, which has returned 9.8% return per year to investors, investing about £1,000 a month, adjusting that for inflation at about 2%, well, in 20 years from now, my investment portfolio would be valued at £1,317,252. That would put me in a rather exclusive club of the 4,000 ISA millionaires here in the UK. Now, I'm sure there'll be many more people in this club 20 years from now, but if you guys drop a like on this video and subscribe to the channel, then hopefully YouTube will push this video out to more aspiring investors so they know how to build their wealth too, and hopefully enter the club one day. Oh, and whilst we're on the topic of ISAs, it's just a tax-free investment account, so you might as well make the most of it. But as I said, public equities only makes up one portion of that 54%, and actually the remaining 17% is held in private equities. Now, private equity is essentially ownership in companies that aren't publicly listed. Now, this is either from owning your own business or becoming a shareholder in somebody else's business. Now, I'm not saying that this is the only route that you can take to acquire that high net worth status, because you can work into the top tiers of the corporate world if that's your thing. According to research from the High Pay Centre, the median FTSE 100 CEO pay is about £3.81 million, which is just over 100 times the average full-time worker pay of £35,000 per annum. But with so few CEO spots available, I guess it kind of validates the point around that ultra high net worth individuals usually become CEOs of their own companies rather than working up the corporate ladder. I transitioned away from full-time employment earlier on this year, and now I'm an owner and shareholder in 3 different businesses, and I'm earning more money now than I could have perhaps ever done working in the corporate world. Now, obviously, working on your own business is one thing, but the other side to this is potentially investing in somebody else's business too, just like you see on Dragon's Den. Stephen Bartlett is a great example of this. He's one of the investors on the program, and he also has his own private equity company called Flight Fund, where he actively invests in businesses. Some of those include well-known brands such as Huel, Zoe, and Whoop. It's all of the brands that he strategically promotes on his podcast.
And as you guys will know by now, Zoe is a sponsor of this podcast, and I'm an investor in the company.
Which I guess is a pretty intelligent way of sharing the products that he believes into his audience in order to kind of indirectly grow the value of the equity that he has within those companies. Now, if I'm honest, I thought high net worth individuals would probably have a little bit more than 54% of their portfolio allocated to equities. But let me now share with you where the second biggest allocation of their money is held. Property being in that second spot, making up 27% of the portfolio. My granddad always used to tell me, you'll never go wrong making an investment in bricks and mortar. And to be fair, I think he's kind of right. But how exactly do ultra high net worth individuals execute on this strategy? Well, about 11% comes from investment property equity. Here in the UK, the property market is a fairly stable investment, returning roughly about 4.5% to investors on average per year over the past 20 years, and that just takes into account the capital appreciation on the asset. It doesn't account for potentially the rental income that you could acquire, which could add a couple of extra percentage points onto that total rate of return too. It's one of the reasons why I got into the investment property game just last year, in order to diversify my investment portfolio, but also benefit from the capital appreciation from the UK property market. Because in truth, UK property ownership has been one of the biggest sources of wealth in previous generations. As at most recent reports, the average house price is now soared to £292,505, which if we compare that to average house prices just 40 years ago in 1984 of just £27,416 according to the Land Registry. That's a 966% increase, which is over 300% more than the returns that you would have acquired from investing into the FTSE 100 over the past 40 years. It's probably one of the reasons why personal property equity, so home ownership, makes up the remaining 16% of the portfolio allocation. There is a saying that goes, don't wait to buy property and wait. And if this data is anything to go by, then it's certainly true. But of course, personal property ownership isn't exactly useful when it comes to contributing to your overall net worth. It's what I would typically refer to as a non-productive asset. And what I mean by that is it doesn't provide you with an income, and the only way to realize the returns on that property is to essentially sell it and buy a cheaper one. And in fairness, that's not the kind of mindset that an ultra high net worth individual probably has. So for sure, own your own personal property if you can, but also try and invest in some too if you ever get the opportunity to do so. The next 14% of this portfolio is allocated to cash and bonds. Now cash is cash, I don't really need to explain that, but bonds on the other hand is a low risk investment where you lend money to either a government or even a company for a fixed rate of return. Now, government bonds are referred to as gilts over here in the UK, and company bonds are typically referred to as like corporate bonds, but you may also find that fund managers will package up some of these bonds and actually sell them as investment grade bonds to aspiring investors. This is a low risk segment of a portfolio, but a really important segment at that. Cash or low risk bonds will provide any investor, regardless of how rich or not that you are, an element of financial stability that no other investment can provide you with. It's the reason why, as you typically get older, the more cash and cash equivalents you're probably going to hold within your portfolio. Even for high net worth individuals who probably don't even need a fraction of the cash that they probably have, even increase their exposure to cash to about 20% as they reach the age of 50. And I bet if this chart went into the 60 and 70s age category, then that cash exposure would be even greater. But it's important to get this part of your portfolio right, because cash is a little bit like a balancing act. When you hold too much cash, it's to your own detriment because of inflation, but then if you hold too little cash, then it could cause some unnecessary financial stresses. So how exactly do returns stack up in this kind of low risk area of a portfolio? Well, cash varies, right? Because it's typically tied to two things. The first thing being the central bank interest rate, which as of right now is pretty historically high at about 5%. The second thing to that is whether you've actually then moved your money into a high yield savings account to benefit from those higher rates. Now, quite shockingly, a report that's recently been done from Yorkshire Building Society has actually said that £366 billion is currently sat in low interest rate accounts earning less than 1%, which is mad because there are tons of different savings accounts right now offering upwards of 4% in interest, with the likes of Trading 212 being one of them, offering a 5% interest rate on their cash ISA accounts, which you can also get by clicking that link in the description below. Now, from a bonds perspective, well, it kind of depends on what bonds you're investing in. Let's just keep things simple and just look at the gilt market, where you've got both short and long duration bonds. So a 2-year bond right now currently pays out at 3.81%, whereas the 30-year bond pays out at 4.37%. So both cash and bonds right now are actually pretty good in terms of being a short-term investment, especially for that 10 to 15% of your portfolio allocation that you want to keep some kind of stable value. Then we have the final 5% of the portfolio allocation, which is actually held in alternative investments. I feel like this is the kind of money that you just play around with when you've got some fun money to use.
Fun coupons!
And look, let me be honest, as much as I am sensible with my investments, or at least I like to think that I am, I think for most people, they kind of have that itch, myself included, to just speculate a little bit on some kind of assets that may just have the potential one day to go up in value by 10 times or 100 times in value. It's one of the reasons why I hold a little bit of cryptocurrency within my investment portfolio. I don't really talk about it, I don't really care about it, but I'll kind of come back in 10 years time and see how I've done. Now, ironically, crypto is also the asset class which is the most popular for ultra high net worth individuals within this 5% allocation, with 39% of participants being sampled actually saying they own a little bit of crypto or NFTs. Do you guys remember the NFT days like 3 or 4 years ago? Kind of makes me think about how much those like crypto punk NFTs that I swear were like millions of dollars at the time are actually worth today. I'm sure one of you guys can let me know down in the comment section below. Other alternative asset classes include precious metals, so the likes of gold and silver being your most popular, along with collectibles too. And if you've ever watched The King of Collectibles over on Netflix, you'll know exactly what I'm talking about here. People will literally pay silly money for old sports memorabilia and playing cards.
$1 million cash up front right now.
I've got a few personal bits that probably aren't really worth any money. I've got a couple of Lewis Hamilton helmets here, along with a Lewis Hamilton picture, which is actually signed by Lewis Hamilton, just in my own kind of personal collection as a little bit of a hobby. Now, the reason why high net worth individuals invest in alternative assets is because either A, it's a hobby, or B, because you can actually get a phenomenal rate of return. Bitcoin has provided a rate of return of 457% to investors over the past 5 years. Back in 2022, this PSA 10 Charizard sold for $420,000, which some kid probably pulled out of a Pokemon pack back in 1999 for about 50p. And even gold has done okay as a precious metal and a store of value in the last 5 years, returning 69% to investors. It all depends on where your personal risk tolerance lies here, but some people have made an absolute killing from these types of alternative investments. So that's exactly how the top 1% invest. Now, I'm nowhere near the top 1%, but if you do want to know what I personally am investing in within my own investment portfolio, then be sure to check out that video next. With that being said, I'll see you over in the next one.